Hello traders, Gary Wagner here. Approximately 10:30 in Honolulu, making it 3:30 in New York. First day of the week, Monday, 9th day of April 2012, and this is the daily report for gold and silver. On Friday, of course, the market was closed good due to Good Friday and then Easter Sunday. So the market really didn't have a chance to react to a jobs report that came in well under expectation. That has caused a sell-off in the stock market, currently 12,929. That's the value of the Dow Jones Industrial, down about 130 points. We have gold up about $11, $10 in that area. As you can see, current print 1641.48. It's ranging anywhere between a low of 1631 and a high of 1649. Silver up about a penny on the day, slightly higher but basically unchanged. Currently trading, as you can see, 31.51. We are looking at a couple of Japanese average charts. They're both shorter term charts, 420-minute charts, and that's going to be the first charts that we look at today. The other thing that we're going to talk about in detail is a revised Elliott wave count, and we'll talk about that towards the end of the show, but I think it's going to give us some clarity in terms of how we look at this market and what our strategy is going to be. In other words, where we think this market is going to go. Now, the one thing that you can see between these two charts is absolutely that where gold has had a nice ascension, you can see this move. You've got these Henkin green candles, no lower wick. They are small, but at the same time, they are moving higher. You can see that that's not the case with silver today, basically changing in unchanged territory. I'm going to go ahead and blow this up, and you can see this in a little bit more detail, but we've got a nice little rally underway from the lows, and we'll call these lows right around 1620. This is a misprint here. Now, when we take a look at silver, it's not really the same. As you can see, silver came down in the same way, started to go up, but has been coming off of those highs, and as I said, is currently unchanged on the day. Traders, there can be no doubt that in terms of an Elliott wave count and in terms of our expectations as to what the gold market is going to do, has been perplexing to say the least. In terms of the wave count, it's not acted normal ways. There's been 2 points already where we thought we had concluded this major fourth wave, and yet the market would head lower. We talked about the fact on Friday that what we were looking at, even though we've got a rally going on right now, is the fact that where we expected a breakout, and that breakout was to come in terms of regards to the market being able to go over the 1680-90 point to make it over the last top that it had, and it wasn't able. In terms of the wave count, I have worked with in the past and highly regarded gentleman named David Bannister. He's got ActiveTrader.com. Many of my subscribers know of his work. The two of us do work together in that when there are real tough times, we believe that two heads are better than one. On work that I've done and work that he's done, we've come up with the following model. And the model that we're looking at right now, and I think that it makes a lot of sense, so bear with me as I go through this explanation, is that rather than a straightforward ABC correction, or even the correction that we have been charting, which is the ABCD correction, it is in fact the ABCD correction, but it's really what is known to Elliott wave theorists as a triangle correction. In terms of how a triangle correction will work, the count's going to remain the same. But first of all, the definitive thing about a triangle correction is it can be defined, first of all, by a series of lower highs and a series of higher lows. In other words, a market that is compressing. The count's going to be very, very similar. It starts from the top of that market, which is right in here in gold, as you can see, when it hit its record high of about 1920, and you're going to look for 5 primary waves within the triangle and then what's called an upthrust or the thrust line. And the way that it would work is this. You would get 1, 2, 3, 4, and then you would get your fifth wave. Following the fifth wave, that is the conclusion of the actual correction, and then you get your upthrust. The defining factor of the upthrust is that it will break out of this pennant or triangle formation itself. Now, the reason that that makes sense to us is that when we look at the clear definition of the triangle wave directly from Elliott wave, we're getting a pattern that's very, very similar to that. Now, we do have one point of contention, and the point of contention that we have is that this low right in here in A should start the beginning of that triangle, and as you can see, it's really well above that. And so that if in fact this is not our first one or A, this would be your number 1, your number 2, this would be number 3. We would get the market going to the top of this range to be 4, and then our fifth wave down, in other words, we would get a bounce, one more retracement, and then a final upthrust. That would be if, in fact, this particular low that we reached, and this is back, of course, in October, September of last year, if that can't be counted as our A. However, for right now, I am going to be counting it as our A. We'll get final confirmation if, in fact, we see the market break through this area. If it comes up to this area, it finds some resistance, that's telling us that the count actually started here. But this is becoming what I will call a textbook case of a triangle correction. Now, what has stymied many chartists or technicians that follow the gold market is that we haven't gotten typical activity that we've seen in the past. And what I mean by that is in the past, this market would genuinely rally and retrace, rally and retrace. And each time you got those rallies, you would get a succession or a series of higher highs, new contract highs, new price highs, new historical highs in the market. And that was the characteristics that we saw within the market. For the first time, you've seen it in essence range bound. When I say range bound, I'm talking about the lows right in here, just above 1,500, the highs at 1,800. So in essence, a $300 trading range. However, the only way we can make sense of it within Elliott Wave was to look for a model which more closely followed the way that gold is tracking or trading right now. Our count is going to be just the same in terms of the way we're looking at it. And the only thing that's different is that we are now aware of the fact that we literally have this compression going on right in here with this series of lower highs. We have this compression going on with a series of higher lows, as you can see here and here. And then we would get our final upthrust. So traders will have to see, but I do want to thank David Bannister of Active Traders. He is the one that first was able to reveal this. It makes perfect sense, and to me, it's the best explanation right now of our current Elliott Wave count. This has been Gary Wagner, wishing you as always good trading. We'll talk to you tomorrow on Tuesday for another daily update and review. Bye-bye.